Hi, I'm Matt Martindale at America's Mortgage, a division of Trail Creek Mortgage with a quick mortgage minute. I've been fielding a ton of questions asking me, Matt, what's going on with interest rates and the mortgage market? So I wanted to take a minute to chat a little bit more about how the mortgage market works and coronavirus. The coronavirus has caused a virtual shutdown of the U.S. economy. This has resulted in significant layoffs. This adds an additional layer of risk to the servicer who, if you remember from part 1, does not actually own the loan or the asset, but does have the responsibility to make the payments to the investor even if they've not received payment from the borrower. Now, in most cases, the servicer has a reserve cushion to manage this risk. However, with a possible increase in delinquencies and rising unemployment concerns, the servicer could be at a high risk on their obligation to the owners of the mortgage notes. The government has sought to help those who are now unemployed, and it sounds like the CARE Act may be granting a temporary reprieve to the COVID-19 coronavirus impacted borrowers. Do you see the problem? The servicer is obligated to pay whoever owns the mortgage notes when they've not received payment from the borrowers. This runoff is an increased risk to the servicers. The value of servicing these loans has lost significant value to the servicers. In an effort to reduce mortgage rates, the Federal Reserve has reduced the Fed funds rates, which has no bearing on long-term mortgage rates anyway, but they have committed to quantitative easing to become a temporary buyer of mortgage-backed securities instead of the free markets. So while the Federal Reserve believes they are stimulating lending, their actions could be causing the exact opposite. Just remember, for every seller, there has to be a free market buyer. If there aren't any investment buyers on Wall Street willing to accept the risk of possible defaults or potentially deferred mortgage payments, it's causing lenders to slow their pipeline down by throttling up mortgage rates, maybe deferring the risk to the borrower with longer lead times, as well as allowing some borrowers to only lock their interest rates 15 days prior to closing. So when the mortgage market is at its highest volume in history, servicers are getting hammered, their pipelines hedged more than ever, the coronavirus hits. It's the perfect storm, and the Federal Reserve has tried. I believe that once the coronavirus subsides and a little less government meddling, things can begin to normalize. Want to talk mortgages? Let's chat. Depending on your situation, I may be able to help by eliminating your debts, lowering your payments, and giving you a cash cushion during these turbulent times.